The sky has collapsed for cross-border trade. The European market is also going to cancel the tax exemption policy for parcels under 150 euros and plans to charge a handling fee for every single parcel. This means that prices at the front end of the European market will definitely rise. This policy mainly targets cross-border platforms like Temu, Shein, and Amazon, as there are concerns about counterfeit and substandard products entering the European market.
Europe's recent move is mainly due to the overwhelming number of small parcels being sent from China. In 2024, over 4.6 billion small parcels entered Europe, with 91% coming from China. That means that every second, 145 Chinese parcels enter Europe, all of which benefit from tax exemptions. France in particular has been overwhelmed by the low-priced parcels from Chinese e-commerce platforms. This situation has only worsened in 2025, with the number of parcels doubling compared to 2023 and quadrupling compared to 2022. The influx of Chinese goods has become so massive that many French media outlets are calling it an invasion.
家人们听说了吗?
Did you hear? Recently, France's foreign trade orders have skyrocketed by 125%. The European market has become the new hotspot. Our foreign trade sector has been buzzing, with French orders growing exponentially. Europe has turned into the top market. The host explains, the European market exploded because of U.S. tariff policies. In April, the U.S. imposed reciprocal tariffs, and in May, it ended the tax exemption for small parcels. As a result, business quickly turned to Europe to avoid risks. Platforms like Temu and Shein have sharply reduced their digital advertising spending in the U.S., shifting their resources to Europe and Brazil. According to Sensor Tower data, compared to other European countries, France and the UK saw the largest growth in ad spending. Shein increased its ad spending in both France and the UK by 35%, while Temu raised theirs by 40% in France and 20% in the UK. Compared to the same time last year, Temu's ad spending in France has increased by 115%, and in the UK by 20%. This advertising push has already shown results. Shein's app downloads in the UK increased by 25% per month, and Temu's downloads more than doubled. Although the increase in downloads is noticeable, the growth in daily active users is limited. Shein saw a 5% increase, while Temu grew by 10%. In light of these developments, the French government has taken action to curb the flood of parcels. On April 25th, the French Minister of Finance announced specific measures to stop Chinese e-commerce parcels flooding the European market. These measures aim to reduce the influx of small Chinese parcels. Finance Minister Eric Lombard pointed to millions of parcels from Chinese e-commerce platforms, particularly from fast fashion leader Shein, cross-border platform Temu, and Alibaba. These parcels not only compete with French merchants, but also create an ecological disorder, with some products even failing to meet European standards. Lombard added that these measures are meant to respond to the influx of goods and protect consumer safety, while addressing the distorted competition local businesses are facing. When asked if the government was considering unilaterally removing the tariff exemption for parcels under 150 euro, the Ministry of Finance said they are studying the legal feasibility of such a move. On April 29th, French Public Accounts Minister Amélie de Montchalin and Finance Minister Eric Lombard jointly announced that France would propose to the EU a handling fee for all small parcels under 150 euro originating from Chinese e-commerce platforms. This fee will not be passed on to consumers, but will be borne by importers or platforms. The funds raised will strengthen customs monitoring and product safety checks. The French SME Federation welcomed this and urged that the situation be treated as an emergency to increase regulatory enforcement. The French E-commerce Association called for immediate action to stop the unfair advantage and dumping practices of Asian platforms. Those who support restricting Chinese low-cost imports say that European businesses must comply with social, environmental, and safety standards, while Chinese imports are almost unregulated. They call on the EU to establish reciprocal rules and sanction proper practices like selling at a loss. The EU plans to completely end the tax exemption for parcels under 150 euros by 2028. France hopes to implement handling fees as an interim measure, negotiating with countries like Germany and the Netherlands, and it aims to have this policy unified across the EU by 2026. The French government plans to trial a new fee system from 2026 to 2028, paving the way for future EU tariff reforms and intensifying efforts to combat counterfeit and substandard goods. France states that the purpose of the system is to ensure consumer safety, maintain market fairness, and protect national financial interests. In April, the European Commission released its annual Safety Gate report, which highlighted China as the largest source of dangerous products in the European consumer market. The second largest source was the European Economic Area, which includes all EU countries. In cases involving cosmetics, Italy accounted for 16%, ranking second to China. In 2023, China accounted for 37%, increasing to 40% in 2024. The report pointed out that since 2006, the European Commission has been collaborating with China's product safety regulatory authorities, with China regularly reporting the handling of dangerous products flagged by the EU. In September 2023, the EU and China signed a joint action plan, agreeing to report on dangerous products flagged from online shopping. Concerned about the influx of cheap goods bypassing regulations, the EU announced the formation of an import monitoring team to address the issue. The team, based at the EU Commission's headquarters in Brussels, aims to closely monitor changes in global product flows and assess whether the new tariffs imposed by President Trump on China are reshaping trade patterns. Reinhard Bütikofer, a China expert and former European parliamentarian, said that China is heavily reliant on exports to absorb its industrial overcapacity. With the U.S. market closed, these goods are inevitably flowing to other regions, with Europe being the top destination. As a result, China may flood Europe with excess production, dragging down local economies into a vicious cycle of price competition. If this trend continues, Germany's economy could be hit hardest. Market analysts note that in sectors like photovoltaics, where Germany no longer has a significant industry, the impact may be manageable. However, in key sectors like chemicals and mechanical manufacturing, the influx of cheap goods could pose a severe threat, even jeopardizing the survival of some companies. To prevent such a situation, the European Commission may introduce targeted restrictions. European Commission President Ursula von der Leyen has explicitly stated that the EU must guard against the indirect impacts of trade diversion. Chinese bloggers have analyzed that these measures in Europe are a fatal blow to cross-border e-commerce. With the U.S. having just canceled the tax exemption for small parcels, Chinese cross-border e-commerce platforms like TK, Temu, and Smartone halted their U.S. operations during the May Day holiday. A large portion of cross-border sellers likely spent the holiday in anxiety. The news regarding Europe has now become a reality, which will have a devastating impact on Chinese cross-border brands. With no markets left in Europe and the US, cross-border e-commerce is essentially finished. Some may point to Southeast Asia and South America as potential markets, but they cannot accommodate China's massive market, especially as Southeast Asia has already become saturated. Therefore, the future of cross-border e-commerce is uncertain. After many years of rapid growth, the industry has now entered a period of adjustment. The approach to overseas expansion may need to change. It will likely require businesses to truly invest in local markets, providing value to those regions. This year, the cross-border e-commerce and foreign trade environments are the same. Both are rapidly entering a phase of consolidation. Sheng Mingshi, a researcher at the Taiwan National Defense Security Research Institute, told foreign media that the U.S. is the primary market for Chinese products. After the U.S. imposed tariffs, China has been looking for alternative markets, and Southeast Asia is unlikely to be a viable option. The most mature and largest market available now is the European Union. If the EU and President Trump can reach an acceptable tariff agreement, the EU should lean towards the U.S. and be willing to clash with China rather than accept Chinese products. In the triangular game between the US, EU, and China, if the US-China trade war escalates, the EU will likely be the winner. The products that China exports to the EU are mostly daily necessities or consumer goods, and these can be replaced by similar products from other countries. Therefore, the EU will not be greatly affected. Taiwanese economist Wu Jialong stated that the European market cannot absorb China's surplus products. China's economic strategy is fundamentally flawed, and it is bound to lead to resistance. From the beginning, China's economic strategy was to overinvest, leading to overcapacity, followed by price competition and dumping products abroad, which naturally triggered the rise of protectionism and trade friction with other countries. EU-China relations are already not as strong as before. The EU-China Comprehensive Investment Agreement was overwhelmingly frozen by the European Parliament in 2021. Shen Mingshi explained that the EU will not accept Chinese products with national capital subsidies or allow China to shift its dumping practices to the EU while the investment agreement remains frozen. Furthermore, the EU will not resume the agreement due to U.S. tariffs. On the other hand, even if the EU is unwilling to accept China's surplus products, Sheng Mingshi believes that China does not dare to actively worsen its relationship with the EU, as it doesn't want to offend both the EU and the U.S. at the same time. The U.S. announced in April that it would impose punitive tariffs of up to 145% on certain Chinese products, and from May 2nd, it canceled the tax exemption for online shopping parcels from China and Hong Kong valued under $800. These parcels now face tariffs as high as 120%. The latest news on May 12th is that the U.S. and China have reached a trade agreement. Both sides have agreed to significantly reduce tariffs within 90 days. The U.S. tariffs will drop from 145% to 30%, and Chinese tariffs will decrease from 125% to 10%, with a mechanism for continuous negotiations. However, the agreement does not mention the issue of small parcel tariffs. Martin Palmer, co-founder of cross-border data service provider Hurricane Modular Commerce, said that logically, if tariffs on other goods are reduced, the small parcel exemption should be treated in the same way. However, there's no clear statement regarding the handling of the minimum tax exemption threshold. In the past, products from Chinese factories could be directly mailed to U.S. consumers through the small parcel tax exemption policy, which helped platforms like Temu and Shein become popular. They expanded quickly by selling low-priced electronics, clothing, and accessories. According to the White House, more than 4 million parcels benefiting from the tax exemption arrive in the U.S. every day. U.S. government officials, members of Congress, and U.S. Customs and Border Protection have opposed this trade policy, largely due to prohibited items entering the U.S. through low-cost parcels. According to the joint statement between China and the U.S., starting from May 14th, bilateral reciprocal tariffs will be reduced from 125% to 10%. However, the U.S. will maintain its 20% fentanyl tariff on Chinese goods, so the overall tariff level on Chinese goods will drop to about 30%. Both sides also agreed to establish a mechanism for ongoing discussions regarding economic and trade relations. This mechanism will be co-led by representatives from both sides. The U.S. representatives will be Treasury Secretary Scott Bessent and U.S. Trade Representative Jamieson Greer, while the Chinese representatives will be Vice Premier He Lifeng of the State Council. The U.S. stated that tariffs on specific industries like semiconductors, steel, and aluminum will remain unchanged. U.S. Secretary Treasury Scott Bessent clarified on May 12th that the U.S. wants strategic decoupling with China in specific sectors, not a broad decoupling of all goods. In an interview with CNBC's Squawk Box, Bessent explained,
We do not want a generalized decoupling from China, but what we do want is a decoupling for strategic necessities, which we were unable to obtain during COVID, and we realized that efficient supply chains were not resilient supply chains. So we are going to create our own steel, protect our steel industry, the work on critical medicines, on semiconductors. So we are doing that, and the reciprocal tariffs have nothing to do with the specific industry tariffs.
U.S. Trade Representative Greer added that tariffs on specific industries are not part of the U.S.-China trade agreement. President Trump had imposed industry-specific tariffs on Chinese-made semiconductors, medical devices, steel, aluminum, and iron products. Trump emphasized that if the U.S. and China do not reach a trade agreement within 90 days, tariffs on Chinese goods will rise again, but not back to the 145% level that existed before the Geneva talks. Trump noted that the U.S. is open to Chinese imports, but the Chinese haven't opened their country to the U.S., adding that this is unfair. Trump further commented that the commitments made by Beijing are not yet finalized. As the trade war cools, financial markets have been boosted. Wall Street futures have risen, with markets hoping that this move will help the global economy emerge from the shadow of recession. Futures for the Dow Jones, S&P 500, and Nasdaq all increased. Nvidia surged 4.6%, while Tesla rose 6.7%. Oil prices also surged over 3%, driving up major energy stocks like Chevron and ExxonMobil by about 2%. European stock markets followed suit, and the Pan-European Stoxx 600 index rose 0.9%. The U.S. dollar strengthened, reducing the appeal of gold as a safe haven, causing gold prices to fall 3% to a more than 1 week low. At the same time, other safe haven assets dropped, with the Japanese yen and Swiss franc both declining. The euro also weakened, potentially facing its worst day of the year. Some investors expressed concerns over the lack of details in Monday's statement, as well as the risk of another trade war between the U.S. and China. While the two countries have 3 months to resolve their differences, the time frame is not sufficient for such a complex trade dispute. It's also unclear what the goal will be when this cooling-off period ends. Bloomberg reported that Roberto Schultz, the head of strategy at Singular Bank, stated that the U.S. stock market is unlikely to return to historic highs in the short term. He warned that even if an agreement is reached, businesses will suffer economic losses due to the uncertainty of U.S. economic policies. Currently, the world is watching the negotiations closely. Commentator Yuan Bing wrote that it's still uncertain whether China will make the substantial concessions that Trump hopes for, such as reducing the U.S. trade surplus, fully opening China's market, implementing structural reforms, and abandoning industrial subsidies. Using China's own rhetoric, Yuan Bing explained that if China agrees to these demands, it would seem like a complete surrender to the U.S., essentially kneeling, which it has said in domestic propaganda that it will not do. The Chinese government is currently stuck in a dilemma. Yuan Bing said that kneeling would not only lose the Chinese Communist Party's face, but more importantly, it would spark internal questions about Beijing's policy direction and leadership authority. Especially if structural reforms are carried out, they would undermine the CCP's authoritarian model of governance. On the other hand, refusing to kneel would exacerbate an already fragile economy, intensifying mass bankruptcies and increase social unrest. In short, whether China kneels or not, it would destabilize the Chinese Communist Party's rule. Thus, Beijing is stuck between a rock and a hard place. While a U.S.-China agreement has emerged, the structural contradictions between the two countries will not be fundamentally resolved by a single negotiation. This much is certain. If the U.S. finds that it has been deceived by China again, the consequences will be dire. Similarly, the trade issues between the EU and China will follow the same pattern. Regardless of how the situation unfolds in the future, the root causes remain unresolved, and there's always the potential for an explosion.